welcome to the firm. On the show this week,
NCRPS coming to an exchange near you, and public interest wins in big pharma face-off. But what about inventor rights?
non-convertible, redeemable preference shares. It's quite a mouthful, isn't it? But I'm saying it not for nothing. Recently, SEBI approved the listing of this instrument, and guidelines are on their way. Now, a preference share is a commonly used fundraising instrument, as you already know, that's neither fully equity nor fully debt. For companies, it's a capital raising instrument that comes without equity dilution and yet does not need the backing of a company's assets. For investors, pref shares rank higher in dividend payout compared to equity shareholders and get repayment preference in the case of winding up. But is there a market for listed prefs? Vaishwani Upadhyay puts that question to experts.
In the past 3 years, more than 25,000 crore was raised through non-convertible redeemable preference shares. In the last year itself, there were 140 such issues, but all via private placements. As currently, there is no framework that allows for the listing of preference shares of any kind.
My guess is most of it will be for internal restructuring. And the reason is very clear. What happens that you want to give money to your group company, you have to subsidiary your group company. If you give as a debt, then there's a deduction of tax at source. There are other regulatory things that the corporates cannot give intercorporate loan. There are restrictions of any kind. Here you make a non-cumulative preference capital where if there's a profit you pay. So whole idea is not to get any return but just to give money without any hassle. So it's a very neat way of doing it.
For instance, in January this year, IITL Projects issued 12% non-convertible, cumulative, redeemable preference shares to the promoter holding company Industrial Investment Trust. In 2011, Aditya Birla Money allotted 8% non-convertible, non-cumulative, redeemable preference shares to its holding company Aditya Birla Financial Services.
Currently, this particular instrument is reasonably niche and actually are issued by companies which are basically opportunity within the context that they are working on. For example, NBFC companies, by nature will raise lots of capital through variety of instruments. So they do actually do such issuance. Also, infra companies who are actually having a back-ended tax return or income also are appropriately suited to do such capital, because this is a subordinate capital issuance compared to any other form of debt, and the companies which is not currently paying much tax will not miss the interest deduction, tax deduction on the interest, and therefore actually they will be neutral to issue a irredeemable preference shares, and they will also benefit from the tax angle.
And now, the listing of this instrument may prove to be an additional advantage. The detailed guidelines are pending, but SEBI has already specified that non-convertible redeemable preference shares being sold via a public issue must carry a minimum tenure of 3 years and a minimum rating of AA-. In case of privately placed preference issues that want to list, the minimum application size per investor has been set at 10 lakh rupees.
Once you have a listing, then especially when you have private equity kind of investors or mezzanine fund kind of an investor who have a limited life and who want to get out, now the company cannot return the money because of capital intensity or the nature of the business or anything. So you have a listing arrangement now whereby you can sell it to somebody else. Otherwise, there was the exit mechanism was restricted to only one person to another person. In the listing now it is one to many. You have much more options available.
This is the first important step by SEBI to create one more avenue for capital raising for companies. I'm not sure at this point in time there are lots of issues pending or awaiting to be issued as soon as the detailed guidelines are issued. However, this opens up a big avenue for capital raising for companies, because listed companies or listed securities can attract a lot more investors than unlisted securities. For example, FIIs, insurance companies, mutual funds, non-banking financial companies can all do, and some of them can only do if it is listed company, and some of them can do a lot bigger ticket size transaction if it is actually a listed security.
But FIIs may not have access to listed non-convertible redeemable preference shares. At least not under the current regulatory framework, which categorizes foreign investments in non-convertible, optionally convertible or partially convertible preference shares as debt finance, subject to strict ECB guidelines. That brings with it several restrictions including end use, eligible borrowers, recognized lenders, amount and maturity.
There is an anomaly today in the RBI regulations, whereas FIIs are permitted to buy non-convertible debentures without them being called ECBs. That's not the case with non-convertible preference shares, and that would have a serious impact on the kind of yield or the coupon that you can have if you want to give these preference shares to FIIs. So there is clearly a need for RBI to look at this again and probably bring it in line with what is expected for a non-convertible debenture. It might be investor by investor, category by category is what I meant. So for FIIs, for example, and for maybe QFIs to begin with, and NRIs of course, RBI might look at this differently compared to an FDI investment.
Listed prefs may draw FII attention, as besides carrying the best features of debt, they also have a tax advantage over other debt instruments like NCDs, the interest income of which is taxable.
From the company's point of view, dividend is paid out of the tax, post-tax money. So that means you first pay tax on your profits and then you pay dividend. So that's one. And secondly, you have to pay a dividend distribution tax, which currently approximately about 17% is what dividend distribution tax. So these are the tax payments which the company has to pay. Investor gets the amount tax-free today. So all the dividends in the hands of the investors are tax-free. On the other hand, when you are trying to sell your instrument to a third party, then there are two ways. It's short-term and long-term. Unlike equity capital, beyond 1 year, the listed equity capital, you have an STT and you have to pay zero tax. Now, that's not what has been clarified as yet. So, if the tax department is ready to do that amendment to will cover even the pref cap into that STT bracket, then beyond 1 year there will be no tax.
A draft version of the impending guidelines indicates some restrictions on non-convertible redeemable preference shares. For instance, companies may be prohibited from issuing such pref shares to fund a loan to or acquire shares from any member of the same group, except subsidiaries of the issuer. The disclosures required are close to standard, including details of corporate structure, key operational and financial parameters, details of corporate guarantee issued by the company, issue rating, mode of redemption, issue price, effective yield, and put and call option price and notification.
I think it will take some time for issuers and investors to really understand how the pricing would work. Couple of important legal risks that investors and issuers will have to keep in mind are that preference shares don't come with voting rights just the way equity shares do. For investors, of course, they don't also come with the same sort of upside that you would typically expect equity shares would give you. At the same time, for the issuers, they have to keep in mind that preference shares are not a burden on their cash flow, much like debt would be. Debt is to be serviced year on year, whether you make profit or not. So these are the kind of issues that both investors and issuers will have to understand when they price these deals.
These are not going to be trading probably like the listed companies that you see or listed shares that you normally find, like an equity share. These probably are going to be akin to wholesale debt market kind of a liquidity, which is actually available whenever there is a need, and there will be a lot of off the floor transactions as well, which will be routed through the floor, and this is not going to be small volumes because the minimum investment ticket size is very big. So the tradability by definition and nature will be low.
It's clearly the first step by the regulator to develop the preference share market. And in an environment where companies are finding it increasingly difficult to raise money via equity, listing of pref cap that comes with a special set of rights and high yield is definitely a welcome move. A lot will depend on the guidelines though that are likely to be notified soon. In Mumbai, Paisani Upadhyay.
It will be interesting to see what kind of demand we'll see for listed pref shares. With that, let's take a quick break on the firm. On the other side,
public interest wins in big pharma face-off. But what about inventor rights?